come to the big story of this evening, which is the second quarter GDP numbers that have come in. Now, why was everyone waiting so eagerly for what this number would be? We know it is a number which captures how India grew or how much India contracted at a time when the economy was just beginning to open up. The series of lockdowns was ending. So what did that really do to the economy? That's what people were waiting to see. It was also hoped that this would give a sense of what the pace of recovery would be at the rest of the year. So in that context, it's a better than expected number. It's beaten the ET Now poll as well, with a GDP contraction coming in at minus 7.5% for the July to September quarter. The big surprise has been manufacturing really, which has recovered faster than expected at 0.6%. Comparatively, agriculture continues to be the bright spot, and services contracting at about 15% was better than expected as well. The Chief Economic Adviser, speaking after the numbers were out, said he's cautiously optimistic for the path ahead. But I think one of the most crucial points he made was that in his view, the COVID-19 infections seem to have peaked mid-September. Listen in.
Q2 numbers are encouraging. What is important to keep in mind is that the economic performance right now is primarily related to the pandemic. Indian economy had indeed picked up momentum by February 2020, only to be halted by the COVID-19 outbreak. Neither the RT-PCR tests nor the antigen tests have actually decreased significantly compared to the month of September. Both these testing has actually remained the same, and yet despite the testing remaining the same, the number of cases has declined, which I think is indicative that the peak was hit in the month of September. Agriculture has been a persistent bright spot, even in Q1 when other sectors did not do well at all. The agriculture had done very well, and that continues to be the case, and it's broad-based across food grains, cereals, and oil seeds as well. Food inflation is expected to soften in third quarter. Inflation is one of the aspects that I think has to be tracked very closely. We should be cautiously optimistic, and the caution is warranted because the economic impact that we are seeing is primarily due to the pandemic. I've provided you the evidence in this context. So the sustainability of the economic recovery, therefore, depends critically on the spread of the pandemic. While we have crossed the peak of the first wave in September, winter months must warrant caution.
All right, Dr. Haseeb Drabu, Yamini Aiyar, Arun Singh joining us on the discussion this evening just to break down what these numbers are telling us. Dr. Drabu, let me start with your take on the second quarter numbers. Like I said in the opening of the show, we live in strange times where an official recession and a slump of minus 7.5% is still good news because it's better than what it could have been. Dr. Drabu, can you hear me? I think you're on mute, sir. All right. I'll come back to you. Yamini, do you want to take that question? Your first overall response to the numbers?
Sure. Thanks, Tamanna. As you said, we do live in strange times where there seems to be a sigh of relief that it isn't as bad as we thought. But to be entirely honest, I think it is worth asking ourselves the question, if we had responded to the crises in the first quarter differently with a more generous stimulus from the government, could things have looked different? And I'm just going to leave that because I think that's an important question that we need to ask ourselves because it frames the kind of economic response that we have seen from government. Two other big observations. I think the manufacturing gains are certainly very good news and a great surprise. But let's not forget that compared, if you go back to last year, manufacturing had dropped. So it's certainly an improvement on last year, but it's an indicator that we have a long way to go. That agriculture has sustained us. It has sustained us from the first day of the lockdown. And I think that the government should think a little bit harder about how it's reacting to, at any rate, we may agree or disagree with the demands of the farmers, but certainly considering that farmers have sustained our economy for the last 9 months, we should give them the dignity of the right to protest. That being said, I think the one thing that does worry me a lot, despite this relatively more cheerful contraction that we are seeing, is if you look more closely at the labor market itself. All indications, particularly from CMIE, are seemingly showing us that there had been an improvement in employment rates in July and August, but by September it stagnates. And in fact, now, October, November, things are beginning to look quite grim in terms of employment rates. And that's a very, very important indicator of the overall health of the economy. And most importantly, of the extent of demand in the economy, which has obviously impacts on everything else. One last point, I certainly do agree with the Chief Economic Advisor that we should be careful because all of this is going to depend on how the virus itself unfolds. I'm sitting in Delhi, which even as we see the numbers are looking a little better for the rest of the country, Delhi is certainly seeing a fairly difficult time. And this unpredictability and uncertainty has a very significant long-term impacts on how the economy functions. Last thing that we should also remember about the numbers, government expenditure has contracted and stayed at minus about 11% if you take quarter one and quarter two. This was a time when I think we should have seen a lot more expansion of government expenditure. It goes back to my first point about the overall response to the lockdown and the economic consequences of COVID-19, which I think still remain an open question.
You know, it's an interesting point on government expenditure because it keeps coming up, and so far what the message seems to be coming in from the government is that they're keeping their powder dry for when things start to pick up. Let's see if that's really happening, will happen, and how much of an impact that fiscal push has had to the recovery. Arun Singh, your take. Even without any kind of massive fiscal stimulus from the Indian government, comparatively, we seem to have had a better than expected recovery. Is that a safe takeaway?
Yeah, thanks. Thanks for that question. And in fact, I do agree with most of us, and more importantly, with Chief Economic Advisor, that he was talking about that start of 2020 we had a green shoot. He was right, because we run a lot of index, and it was clear that green shoot was visible. In fact, if there is no COVID, I can certainly say that 7% or 7.5% growth was nowhere. In fact, it was supposed to be more than that, and that's a reality, and that's what happening. Things were started looking good, and COVID, March lockdown, hit the pause button, and things deteriorated. Now, if you take a cue from that, your investment basically stalled, your demand basically stalled. You're in a lockdown phase. Q1 of financial year certainly have seen a degrown. And that's precisely the point, that Q1 was slightly worse than earlier expectation. As a result of that, you have a Q2, which is slightly better than the expectation. See, please understand, this is also the data collection method. If you ask the GDP calculating authority, CSO and then Ministry of Corporate Affairs, they get data and they get data sometime in the lag and they automatically get reported. If that is the case, then I would not be that happy that, recovery is better. So we have to be basically very cautious. I do agree that we have to be cautious. My biggest worry here that manufacturing was completely under the lockdown. The moment we started unlock one, things started going back to the normal. In fact, when I looked at industrial index production, not just for India, across many other markets, in month of October, we were almost, in fact, not October, in fact, September, we were almost pre-COVID level in terms of the index, in terms of the stock market, and in terms of other parameters, which means we went back into the pre-COVID era, and manufacturing, because people were not working. All of a sudden, they were allowed to work. Things improved. My biggest concern at this point of time that there's a slight improvement in services sector. I do understand you have a trade, you have a hotels, transportation, communication. These are the sectors. In fact, hospitality, to be honest, is severely hit. But look at their contribution in the overall GDP. You have a very good digital rate in terms of the services sector in India. In spite of that, you can't see that improvement what we were expecting in that phase. That could be a serious drag, going forward. And of course, we talk about, I don't know whether you are going to explore that.
Arun, I was looking at a forecast that DNB has put out. If I may come in, I was looking at a forecast that DNB has put out, and you have said in that the fears are, because let's look forward now, the fears are that a second wave of the COVID-19 pandemic could derail this recovery. You also talk about growth from November tapering off due to a base effect. The logic seems to suggest that if we have done better than expected in Q2, Q3 will even be better, because your high frequency indicator started kicking in really well after September.
Exactly, that's our projection, and that's basically Q3 data is showing a slightly better result than the Q2, and that's going to happen. In fact, Q4 we are expecting slightly positive GDP data. We have what we call the Business Optimism Index survey done on the 500 top companies in India, who basically contribute something around what I can say that 40 to 50% of overall productivity in India. When we talk to them, there is a significant improvement in the optimism for the Q3. But the one comment everyone made about the possible second wave, and that's what basically we were talking earlier, that in that scenario, second possible COVID-19 event might erode that 100 basis point GDP data from today's projection. If we are projecting minus 9% GDP growth, this could go to the minus 10.5% for this year and 1 point lower even in 2022.
Okay.
So that's the biggest concern at this point of time, along with what we just spoke, because I just wanted to talk about the government expenditure.
I've got Dr. Drabu back. Yes, I'll come back to you, sir. I've got Dr. Drabu back on the line with me and on a better, clearer line, hopefully. Dr. Drabu, your take on the numbers. The big takeaway is that it's not as bad as it could have been. Can we really see a positive growth as early as Q3, Q4?
Tamanna, what I'd kind of start off with is that let's not waste too much energy and time on trying to prove or disprove that there's a recession. That's a mere technicality, to be honest, in the situation that we are in. Also, a comparison between Q1 and Q2 is a bit misplaced, because Q2 has a lot of seasonality. You always compare for growth purposes year on year. So you're not comparing likes to likes. And this was a season which is, in the earlier times, used to be called the busy season. And we used to have a credit policy for the busy season and the festive demand and all that. So let's try and just understand the numbers that are coming through with today's quarterly results, the quarterly numbers. First, a comment on this whole pre and post-COVID which you're showing. The Chief Economic Advisor suggested that it's only a post-COVID effect, forgetting the fact that we have moved from 5.7 to 3.1. I hope this is not, again, Wikipedia kind of sourcing of data. Now, when you look at the numbers as they have come today, what are the big pluses? The big plus really is that investment hasn't shrunk as much. Now, there's a catch in that as well, because investment has shrunk, but not as much as that of GDP. Therefore, the rate of investment is showing to be better than what was in Q1. The other big plus point really is that exports have done well. So there is an autonomous element of demand. Public expenditure, again, a critical element of autonomous demand, which would generate a recovery, hasn't picked up, but the plus point being that perhaps in second half you could do better, with given that the borrowing is not still complete. So you can look at public expenditure becoming a major source of recovery, which is what Yamini in some ways was talking about, that in the first place itself, if that had been factored in, you may not have had this situation. Even with this kind of contraction, reduced contraction, one is still among the worst affected economies across the world. So there is not much to cheer about in terms of what has happened. Also, I would look forward rather than looking back, is that Q3 and Q4 will be very critical, because you will see a major crisis coming up in the financial services sector. You will have banking, a lot of distress, because you will have the moratoriums go out. You will see a lot of rise of NPAs. You will have capital adequacy issues. And as it is, you're seeing in this quarter itself that financial sector is actually doing very, very badly, which is indicative of what it portends for the future. So once you get into a growth momentum, you will not be able to sustain it because of the crisis that will emerge in the financial sector, more specifically the banking sector. And we still haven't looked at how it will impact their capital adequacy and their future. So there is a genuine concern that needs to be addressed, rather than look at it in terms of binary of we were 23, now we are 7. I don't think that's a fair thing to look at. Just understand what the numbers are showing us in terms of the specific, let's say, gross fixed capital formation hasn't collapsed, but shows a rise because it has fallen less steeply than GDP. So what you're really saying at the end of the day is no recovery or recession. You're just saying that the rate of growth has shown an improvement. The rate of growth is still fairly negative and among the worst in the world.
Talking about Q3 and Q4, and let me come to Yamini on this as well. Just this week, RBI Governor Shaktikanta Das pointed out the challenge of sustainability of festive demand. And Q3, as Dr. Drabu also said, is very, very critical. What are the factors that you're looking out for, especially in the banking space, considering a lot of banks say, preliminary, that not too many companies are coming in for restructuring at all? Is that something which is heartening?
Well, I think that we have to wait and watch. I think that as Mr. Drabu also was saying, that the full impact of the loan moratorium, etc., will only be visible in the financial sector from now. I think that one of the consequences of the heightened festive demand sort of tapering off is already visible in the CMI high frequency data on employment rates, as I mentioned earlier. And I think that that's something that we should certainly look at very, very closely and very carefully. And I also think that one of the things we still haven't got is an understanding of the government's own overarching projection. We know the RBI has told us its own understanding of what its projections of the overall real GDP fall that's going to for this year. We don't really know what the Ministry of Finance is thinking. We're heading into budget season. We know that they have government expenditure has contracted. States too have to start making their own budgets. And I think that the complete lack of understanding of the government's own projections and the basis on which then one can start budgeting going forward is going to be a significant factor that will induce further unpredictability into the economy.
Dr. Drabu, let's come to the point about government expenditure, and I want to position the question like this. You were right to say that let's take it forward looking now. Q3, Q4 are crucial to make sure that we sustain and we build upon whatever recovery we have seen. What can be done now? Do you think there is scope for more fiscal stimulus, which will stabilize this kind of a recovery trajectory?
Without doubt, there is need for heightened fiscal stimulus, which hasn't really happened. But more than the level of public expenditure, what I would today look at is the structure of public expenditure. Where is it going? Are you just going to get into transfer payments of a certain kind? Are you going to get into capital expenditures? With what time frame? With the constraints that one has? Are you doing it directly, or will you operate through the states? Because that is also becoming an issue. You cannot run this economy from the national perspective alone. You have to see how different states have reacted to this and at what level of economic recovery the states are in. So more than the pure number of public expenditure, I would focus more on the structure of public expenditure and the forms in which it is done. So I think that would be a key factor to look at in particularly in this budget. What gives me some hope for public expenditure to pick up is the borrowing program still largely remains to be yet completed. So you will not have a financing problem of that kind in terms of, because the tax numbers haven't looked very good. So in a sense, it has been managed prudently. So you are looking at a better second half from a purely an autonomous public expenditure perspective. There is flexibility, there is room for the central government to actually increase the overall level of public spending and squeeze it into these 2 quarters. What would also be very, very critical in the entire sentiment would be what is the budget going to communicate in terms of a direction, in terms of a policy stance. We're not looking at hard numbers in terms of, what level do you want to put it in terms of GDP, 14% of GDP, 15% of GDP. But directionally, are we going to see an expansionary fiscal policy which will be complemented by a equally accommodative monetary policy? To me, that is not clear yet. So we are still running into a contractionary fiscal policy and an expansionary monetary policy, then move between the, switch the two. So somewhere there needs to be a coordinated macroeconomic policy response involving the state governments as well, because they also spend almost twice the amount that central government spends. So we need to look at it from a macroeconomic perspective rather than a central government perspective also. So the budget, I think, is a key document which needs to look at how do you want to manage the post-COVID economy, not just for next year, but also for the next 3 to 5 years, because this is the new norm and we need to adapt to that. How do you transition the existing capital assets into becoming more relevant, more productive in this situation? So I think it's much more than purely fiscal policy issues.
Right. We're in for the long haul, and this is perhaps the first of the few steps towards recovery. For today, the number looks good, better than expected. That's the key takeaway. Thank you so much to all of you for joining us on the big discussion this evening.